Thailand went broke, and within weeks, Asia began to fall, one by one. This is the story of the 1997 Asian financial crisis. It's me, and this is an economic history hot tip. The year is 1997, and things are looking great in Thailand. The economy has been growing like crazy, but that comes crashing to a halt after the Thai baht collapses. Investors panicked and money fled Asia overnight. Within a few days, Thailand's finance minister resigned. Their currency, the baht, had fallen 15% against the US dollar in a single day. But Thailand's pain would soon become everyone's pain. Like dominoes, one country after another fell. Indonesia's rupiah collapsed. South Korea found itself needing a $58 billion bailout from the IMF, the International Monetary Fund. Malaysia, Singapore, and the Philippines saw their currencies plummet. Millions lost their jobs, their savings, and ultimately, their homes. Two sitting governments fell, and riots broke out in the streets. At the end of 1997, the Asian financial crisis had taken 6% off of Asia's combined GDP, which at the time was around $3 trillion. How did this happen? Well, the answer is pretty complicated, but let me try to break it down for you. First, there was a lot of debt in the region, both private and public. Second, there was a fair bit of overconfidence. And third, many countries pegged their currency to the US dollar, meaning that while they could manipulate their currency value to some extent, they couldn't set it freely based on supply and demand. You can see these three factors playing out in the lead-up to the crisis. So first, the debt. In the 1990s, many businesses and banks took out loans in US dollars because interest rates were lower there than borrowing locally. Plus, the thinking went, well, our economy is growing fast, so we'll be able to pay off the loans with no problem. That was the second factor, the overconfidence. They simply did and appreciate how risky it was to take on all this foreign debt and exchange rate risk. For example, when you borrow in dollars and earn revenue in local currency, if the local currency weakens versus the dollar, your debt burden goes up. That's what happened in 1997. These companies thought they had more cash flow than they actually did, and they thought their currencies would stay strong. But they were wrong on both accounts. Now, third, the fixed exchange rates. So many countries in Asia had fixed or semi-fixed exchange rates, meaning that their central banks were committed to keeping their currency's value within a certain range versus the US dollar. This meant that if a run on a currency started, well, the central bank had to spend its reserves defending the currency, buying it back up. But if the central bank runs out of reserves, then the currency will fall, and it won't stop falling until market forces reassert themselves. And just to complicate matters even further, the US dollar itself was appreciating, making it harder for these countries to maintain their fixed exchange rates. The appreciation of the dollar in the Mid-East was driven by the increasing popularity of the Global 500 Index Fund, which held stocks from only the largest 500 American companies. More investors piling into these funds drove up demand for the dollar, which in turn appreciated the currency. So it was a sort of self-fulfilling prophecy. More investment came in, the dollar appreciated more and more. Okay, now that we have all that context out of the way, let's get to the juicy part. It's May 2nd, 1997. The Thai baht is in trouble. Investors are dumping the currency, and the Thai government spends its reserves trying to prop it up. But it's not working, and something strange happens. The Bank of Thailand starts selling government bonds to try to mop up excess liquidity in the system. When people buy these bonds, they hand over their baht to the central bank in exchange for the bonds. This takes money out of circulation and strengthens the baht. But wait, if you want to strengthen your currency, why start selling government bonds? Isn't that kind of counterintuitive? Here's how it works. To understand what's happening here, you need to know that there are two main ways to make money as a bond trader. First, you can buy a bond for X amount and then sell it for more than you paid for it. That's capital appreciation. Second, you can collect interest payments while you hold the bond. This is called income. Now, in general, the longer you hold on to a bond, the more likely you are to experience capital appreciation. But also, the less likely you are to collect interest payments. This is because long-term bonds generally offer higher yields. So they do and have to increase much in price before you've collected enough interest to make a profit. By contrast, short-term bonds pay you interest more frequently. So if you plan on flipping them, you're better off buying short-term bonds. So if the central bank wants to weaken its currency, it can do so by buying long-term government bonds. This leaves more money in circulation and devalues the currency. If the central bank wants to strengthen the currency, it can sell long-term bonds, which sucks money out of the system. But that's not what the Bank of Thailand does. Instead, they sell short-term bonds. Why would they do that? Well, here's the thing. You always want to do what you believe will work, not what you hope will work. And what was going to work in this situation was selling short-term bonds, because it's not just the central bank trying to affect the baht's value. Everyone else is too. And they're all doing the same thing. They reselling short-term bonds to get their hands on baht to dump it on the foreign exchange markets. This creates a self-fulfilling prophecy, where the more people sell their baht for dollars, the weaker the baht gets, the more people sell their baht, and so on and so forth. It's the exact opposite of what the central bank wanted to happen. By May, the Bank of Thailand had spent most of its foreign reserves propping up the baht, and it was UNA. With no other options left, they let the baht collapse. Long story short, this kicked off a chain reaction across the region, starting with Malaysia, which was particularly exposed to Thailand. Its central bank spent over $20 billion defending the ringgit, the Malaysian currency, but eventually gave up. Then it was Indonesia's turn, followed by South Korea, and the rest. Why does any of this matter in 2025? Well, fast forward to today, and you'll find that many developing countries are heavily in debt, again, especially in U.S. Local currencies are also weakening, again. As we speak, India's rupee is down 10% versus the dollar this year. China's yuan is down 7%. South Africa's rand is down 15%. Brazil's real is down 13%. Argentina's peso has collapsed by over 200% since 2018. And Turkey's lira has lost over 90% of its value in the last decade. So my question to you is, could it happen again? Is the world really watching emerging markets like a hawk? And if so, are we out of the woods? Let me know what you think down below. And if you enjoyed this episode, check out the series in the pinned comments. Shout out to our supporters who make these videos possible. And until next time, stay safe.